Schein with REI, and welcome to our View from the Top video series where we interview CEOs exclusively from our sponsoring firms. Today we have Stuart Boesky, CEO of the Pembrook Group. Welcome, Stuart.
Nice to see you, Jonathan.
Thank you. So let's get started. You launched your firm in 2007.
Correct.
Interesting timing.
Yeah, it was a very tough time. However, we knew where we were in the cycle, and we planned for it, actually.
Okay, now what does it take to create a business that has weathered several downturns, especially this last one?
First of all, we firmly believe that there's a place for optimism in this world, but it's not necessarily for those who manage money for other people. So we went into our business knowing that we wanted to manage to the downside. In other words, under the worst scenario, how can we make sure that our investors aren't hurt? So we planned our balance sheet accordingly. I think that the biggest mistake fund managers make is that they focus on their assets totally and they neglect the liabilities. We look at both sides of our balance sheet the same. And in other words, we closely manage both sides of our balance sheet because we want to make sure when there's a lack of liquidity in the market, we can withstand it.
So, what are some of the lessons you've learned during this last down cycle? Because this was a very dramatic down cycle. What, strategically, operationally, just from an internal sense, what have you learned?
Well, again, I think the clearest thing we learned is that if you focus on and pick good assets, but at the same time have staying power because you have well-designed liabilities, ultimately your business model is going to prevail.
And where do you see the next, greatest opportunities, and where do you see some of the biggest threats?
Clearly the biggest threat is, and I'm not going to prognosticate terrible things, but clearly the thing I think that most people are worried about is expansion of cap rates and increases in interest rates. And we all know that to a certain extent that's happening. Nobody can accurately predict how drastic they may be. One of the reasons we like what we're doing, which is a debt program, is because we can take advantage of both expansion of cap rates and increases in interest rates. We're a floating rate lender. All of our liabilities are floating, so our spreads actually increase in a higher rate environment. And when I say take advantage of expanding cap rates, it's not good for anybody, but it's certainly worse for the equity than it is for the debt. Our portfolio averages probably 68 to 70% loan to value, so we have 32% equity in front of us. So when and if cap rates expand, we have protection in the form of equity, which is our top loss.
So, being a debt-related firm, why do you see so many more debt-related products and funds coming on the market?
Well, we've been doing it since 2007, 2008.
A little ahead of the curve.
And I think that over time, people have recognized, larger fund managers, people who are in the equity business, expatriates from Wall Street, have recognized that debt is a great place to be as long as you can get double-digit returns like equity without taking the risk of equity. I think you're gonna have more players. Some of them better than others, some of them more experienced than others, but certainly as an investor, you're going to have different styles and different disciplines and different capability to choose from.
But do you think they're here to stay, or do you think this is just because of the market and where we are in the cycle that it's something that's going to, you're going to stay, but do you think it's other funds are going to come and do this?
We are of the opinion that it's more likely than not that this is not just a cyclical change, that this is actually a more fundamental change, a structural change in the way commercial real estate gets financed, and it's almost entirely driven by re-regulation of the banks and consolidation of the banks. As long as the banks are under pressure from the regulators, and as long as the banks keep getting larger in size. 60-70% of the deposits are in the top 5 banks. There's going to be a place for a mid-market lender who's not regulated to take advantage of the places that the regulated lenders can't go.
I mean, do you see legislation changing anytime in the near future?
I actually slowly am seeing the regulations take effect. A lot of the regulations were prospective, and they're now actually being put into place by the lenders. So at least currently, I don't suspect that. Nobody knows what happens if one party takes control of both the presidency and the Congress. If that is the case, there certainly could be a loosening of regulation, but I'm not prepared to predict that at this point.
And so, just in closing, if you had to do one thing differently, what would that have been?
I think I would have been a right-handed pitcher for the Detroit Tigers.
Truly spoken, Stuart Boesky, the CEO of Pembrook Group. Thank you very much, Stuart.
Thank you, Jonathan.